All right, let's talk a little bit about what we're going to do today. We're going to finish up Chapter 5. We're going to finish the cash flow statement. And should be able to get your exams back today. I'll give them back to you today. The solutions will be posted later today or tomorrow. What I'm going to ask you to do when I give them back, I'm going to put all the instructions up on the screen, and probably someone will still come up to me and say, but you know, just wait, take the exam with you, review the exam carefully, make sure you look at all the points, make sure you know what you got wrong, how much it was worth, and then write all your questions down, and then come and see me during office hours on Thursday. All right, because what happens is if people start running into me in the elevator and say, you know, could you look at this or whatever, it doesn't get done the right way. So in order to be fair to you, I want to sit down with you and go over the exam with you. The average was 80, which means there's no curve. That's a graduate, you know, what I would expect a graduate class to get on this test. If you got below the average and you want to talk to me about it, that's fine. Also, you know that I've got a memory for people that is beyond most human beings, that I know who's here. I have a photograph. Sometimes I could take attendance when I get home. I just can take a picture of the class. I know who's here. So I have, some of you have lateness problems. Some of you have cut problems. So I'll talk to you about that as well. And that's not in the exam grade, but it's something you have to try to, you know, correct going forward. The biggest, I guess, issue that students sometimes have with these exams is that I don't put points on the test because I have to wait and see how everyone does. I mean, I'm not going to make a question like 90 points and everyone blows it and then I have to recalibrate the test. So the way it works is that each problem is 25 points each, but the sections, you know, we have to think about how those sections are allocated, and each essay was 10 points. So each one was 25 points, that's 50, and the essays were 10, so it's 70. And I think most of you did very well on the problems. Where we found some big holes in the grading was the essay questions. So we'll get to them. Okay? So I'll give those back to you later. I'm going to put a sheet up with instructions again, just to remind you of what I just said. And I'm going to say it twice because inevitably someone's going to be running upstairs. You added the points wrong or something, you know, and it'll happen. So I just want you to know you're better off just waiting, getting everything you need to say on one piece of paper or a couple of pieces of paper, and we'll go over it in detail. All right, now, with respect to today's material, let's just go through, we're finishing the cash flow. So I just want to be sure, does anyone have any questions now on this simple, we're going to do two questions. Anyone have any questions regarding, this is, let me get the page because my page is different than yours. This would be page 13 of the third module. Anyone have any questions about any of the adjustments we looked at, direct versus indirect? Now, the way I like to do this, hopefully I've simplified things for you a little bit in that you must understand that direct and indirect use the same adjustments. They're just done in slightly different directions. So again, if you look at the illustration, I'll just go over it briefly. You have a company that has sales of 3, depreciation of 6, selling general and administrative of 4, and tax of 2. And then from the balance sheet, just some selected items, you've got increase in receivables of 2, increase payables 1, and a decrease in tax payable of 1. And I want only the operating activities because that's the only section that's affected by your choice of whether it's direct or indirect. And on the indirect format, which is a reconciliation format, which reconciles net income to cash from operations, essentially converts net income to cash flow or to a cash basis approach. You add back depreciation. Again, you know that is a non-cash expense and it did not use up any cash, so we add that back. Receivables go up, which means that you didn't collect all your sales that are included up in net income, so you subtract it. Increase in payables means that some of the expenses that you charged against income were not paid, so you add that back. And decrease in tax, that means not only did you pay for this year's taxes, but you paid for some of last year's, so you paid more, so you'd have to subtract that. As a liability goes down, you're paying off and cash goes out the door, and operating cash flow is $2,200. Now, when you look at the direct approach, that is an income statement approach where you convert each line item from an accrual to a cash basis. So that's the accrual basis, that's the cash basis. This is just a worksheet so that if you notice, all of the adjustments are identical. You don't do anything different, except that you apply the adjustments rather than against aggregate net income, you apply it against the individual line items. So you've got sales of 3 and receivables increase. That means you collected $2,800 from customers. Depreciation expense does not appear on a direct method cash flow. We just zero that out. SG&A expense was $400, but since you had payables of $100, that means you only had a cash expenditure of $3. And then finally, you've got the decrease in tax payable, meaning that you paid for the taxes you charged against income on the income statement, but you also paid for some of last year's expenses. So once again, just to review, and as I mentioned, a lot of people take some exception to intermediate 1, because even intermediate 2 sometimes, because we go over a lot of what you already have seen in intro. And if you understand it, of course, you're bored. But if you don't understand it, this is important. So let's make sure you understand that under the accrual basis, you would have charged $200 because that's the expense that is matched against this year's income. However, on a cash basis, we don't care about the matching of cost with revenue. We're concerned more about what? When you spend the cash. So the fact that you paid for the taxes this year plus some of last year's means that you have to increase the tax or the cash outflow for taxes by 100, or a total of 3. So your worksheet tells you that the operating cash flow has to be the same as what? The indirect approach. Now, this is not an indirect approach for the next exam. If you wanted, the direct approach rather, it's only a worksheet. If you wanted to see the direct method, you would have to look at the minimum line items. I mean, you don't have them all, but you've got cash collected from customers, $2,800, cash paid to suppliers of 3. You also have cash paid for taxes of 3, and then, of course, the same amount as your direct cash flow from operations. Okay, so that reviews the last thing we looked at, and I always like to do that. Does anyone have any questions there, direct versus indirect? And as we said, you don't see the direct method too often in practice, but it is preferred because if you had to forecast cash flow, if all you have under the indirect approach is 2,200, that number has a lot of noise when you forecast it. So what financial analysts have been telling the FASB for years is that we want to be able to forecast cash collected from customers separately. We want to be able to see how much we pay to suppliers. We want to forecast that separately. And we want to see how much we pay for tax and forecast that separately, and then bring it together to get a better measure of future cash flows. So technically, if you were to forecast each one of these separately, you should get a better or more accurate forecast than if you use the aggregate cash from operations. And that's the justification or the reason why financial analysts prefer the direct approach. Now, again, whether or not that's happening in practice is another thing. And of course, analysts could, if they're well informed with respect to accounting, can actually create a direct cash flow from the indirect method. Again, another thing you can look at, I think this number is important. Cash collected from customers is probably, if you did a trend of cash collected from customers over time, that may actually be more revealing than some of the financial ratios we use on an accrual basis, like the days sales outstanding. Maybe this is a better measure. So there's a lot to be said for the direct method. People do not, in the United States, just don't use it. Again, probably because it is maybe more transparent. I really don't know the reason. It is, often said that the direct method articulates better with the indirect method, rather, articulates a lot better with the financial statement. So, for example, you should be able to trace the numbers on an indirect method a lot easier than the direct method. So anyone, even a casual user of financial statements, should be able to do what? Find this number where? On the income statement. And I showed you on the Coca-Cola case that it's easy to find. Depreciation, you'll find that someplace. You could take the changes from the balance sheet. So I think the justification for using indirect is that it articulates better. It raises fewer questions in the marketplace with respect to the numbers that are presented in the financial statements. It is easier for a casual user to understand. the casual user gets more comfort in tying all these numbers together. So I think, from my standpoint, that's the reason why we find the popularity of the indirect approach. It's almost impossible. I mean, I look around for financial statements. When I find good ones, I'll put them in. You know, I don't spend forever looking for them, but if I'm looking for an indirect cash flow, I could find one in 5 minutes. Direct cash flow could take me hours for a U.S. company. You know, I found one, like, you know, from the county of Sarasota in Florida, but that's governmental accounting, that's not financial. So you don't always find, it's very hard to find U.S. companies using the direct method. All right, so does anyone have any questions on that review? Okay. All right, so let's just try a couple of questions. Just want to be sure. There's 2 of them that I want to go over with you. All right, this first one, I want to see if we're clear about classifications when they get tricky. So here's one. A collection of a loan is reported as an investing activity in the statement of cash flows. Okay. All right, so let's start the timer. Let's see what we got. All right, so we want to see if the collection of a loan of course, A is true, B is false. Yep. Yeah, you know what? You got to be able to make sure it's on channel 41. Okay. Yeah, it's got to be sure you're on channel 41. Okay. All right, now you can do it. All right. Okay, so, yep. Yeah, you guys got to get these straight. Channel 22 is not going to work. Okay, so. Should be 41. Yeah, make sure you have these things set before you get here, if possible. All right, just leave that for now. Oh, you're on 41 now. Okay. Yep. You go. Okay. Yep. Okay. I have to. Okay. You might have a. I'll have to check that as a. Okay. I'll have to look at it. If it's not working, we'll have to get you another one. Okay. All right. So the answer here is what? A. So somewhat of a problem, in a sense that. It's true. If you put B, what were you thinking? You're thinking that it's what? What kind of activity? Financing, and you read it wrong because it said loan receivable, not loan payable. So if you put down false, you're thinking in terms of financing on a loan payable. This is a loan receivable, and for us, it's an investing activity. But what has to be true for this to be investing? I'm sorry? No, but what about the nature of the business? Right, you will, but yeah, it's not a financial service company. If this was a financial service company, where would that go? Operating. Yeah. So, I mean, that's, again, where I like the true and false, where I like you to explain things, because you'd be able to say, well, if this was a financial service company, it would be operating. Okay. So that's why I would like to leave it more open than this. Okay, one more. By the way, the reason why it's a polling closed is maybe it may have gone in after the clock stopped. So let's try it again. So everyone, let's make sure you're on 41, and let's do one more. Okay, so let's just do this one. Yeah, that's the one I'm going to do. Okay, so what I want to know here is if common stock is issued to acquire an $8,000 machine, how would the transaction appear on the statement of cash flow? So again, you're on channel 41, and now the polling is open. You should get a response if you click. choice?
Sure. Just want to make sure it's reading. Oh, I just went away.
Yeah.
Press it.
That's it. Yeah, that's it. I mean, if you change your answer, it'll register the answer as long as the clock is still going. All right, so again, where would this appear on the statement of cash flows? And let's just see if we have. And these are the two questions that I think would lead to discussion. I mean, the others are pretty much definitional. Yep. Okay, hold on. Let me just finish this first. Okay. All right, so let me just tell you, of course, the answer would be D. Okay, because again, this is why is it D? Aside from just guessing. Yeah, it is a non-cash, significant non-cash investing and financing activity. Significant non-cash investing and financing activities will go into a footnote or a separate schedule. We explained this a little bit on Tuesday with respect to the fact that it is benign or it's not harmful if you put this in both investing and financing. You know, the investing activity would be buying the equipment, the financing would be issuing the common stock. But again, under the rules, under both U.S. GAAP and IFRS, we do not include significant non-cash investing and financing. Now, one last point here, and that's why I use these questions, is to make sure we cover all of what I think to be some of the nuances that tend to get confusing. This is a non-cash investing and financing activity. It does not appear on the statement of cash flows. Non-cash items in operations are adjusted in the operating activity section, right? So what's a non-cash item in operations? Depreciation, bad debt. So just make sure you distinguish in your mind that operating cash flows will include some non-cash adjustments. But for investing and financing activities, that's not going to be true. It has to be shown as a separate schedule. All right, so now, before we go on to anything else, we're going to do actually what we're going to get to is a comprehensive illustration. This is the next module. You're going to find that this will get you through all of the computations. It'll get you through all the procedures, the mechanics, as well as the disclosures. And then there's a self-assessment question in there. I'll post the answers to that in a couple of days. You could try that. This self-assessment question is designed to make sure that you are, in fact, very clear how to put together a statement of cash flows up to this point. Now, again, the statement of cash flows gets much more complicated as we move along and we bring in transactions like pensions and leases and deferred taxes, because now, of course, they have to be built in to the statement as well. All right, so are there any other questions on this one or anything else? Okay. All right, so let's go to this last module in 5. And what I want to do here, of course, is to make sure that we cover a very detailed illustration of the cash flow statement. That'll include both direct and indirect reporting formats. I'll show you a little bit about the IFRS statement. I want to talk a little bit about, just very briefly, this financial statement presentation project, which has been put on hold. But just to let you know it's there, you should be aware of what's coming, or at least what's in the pipeline. And then finally, there's the self-assessment exercise, which I will ask you to do. Now, I'm going to try to keep some information for you up on the screen as we move along, or up on the monitor here. I know it's going to be a little rough as we move along, but let's put this right here. Okay. All right. We'll get that on the screen as well. All right. So let's take a look at our sample company. We have Gibson Corporation that has sales of 500, cost of goods sold of 1, calculated by beginning inventory of 120, purchases are 560. Then we have our goods available for sale of 680, minus ending inventories, cost of goods sold, so the COGS is 380, gross profits 120, and then we have our operating expenses. We have selling, general administrative of 30, depreciation of 22, tax expense of 21, and interest expense of 10. The net income for the year is 37, and we also then tell you that we attach the retained earnings statement here, which tells you that there is a opening retained earnings of 40, dividends declared, not necessarily paid. So you have to be careful. I'll tell you in a second, and then ending retained earnings. Now, I'm also going to help you solve a cash flow statement. What I would ask you to do when you read this is look for gains and losses, look for non-cash expenses, look for dividends, interest, taxes. See what the company has and how it's going to affect your cash flow statement. So I've got one non-cash expense here, which is depreciation. I don't see any gains and losses. Dividends, now I know these are declared, but are they paid? How would you know if the dividends are paid? If I don't tell you, what evidence would lead you to believe they are paid or not paid? Payable, right. So you go to the balance sheet. If you don't see a dividends payable there, you know the dividends are paid. So those dividends may or may not be paid. If they are just declared but unpaid, what kind of a transaction are they? Significant non-cash financing activity. So they would only be disclosed if they are unpaid at the end of the accounting period. Okay. All right, so that's your income statement. Now I'm going to go to the balance sheet. And the balance sheet is not classified. It's an unclassified balance sheet. And has cash and cash equivalents. It has receivables, inventory, prepaid expenses, plant assets, and accumulated depreciation. It also has accounts payable, accrued taxes, long-term debt, capital stock, and retained earnings. Now, I don't see any dividends payable, so right now I can start making a list of items that I'm going to need for the cash flow statement. So right now I know I have dividends of 12. They are declared and paid. No dividends payable on the balance sheet. So that's why I know they're paid. So that's going to be a cash outflow for the company. I also know I have depreciation. And the depreciation expense for the year was 22. And that's just coming off, again, of the income statement. And then we'll go back and look at the other numbers as we need them. So this is my only non-cash expense. And there's no gain or loss reported, as we said before. All right. So now, some of the key items here are going to be found in your additional information. So it tells us that the company paid $105 in cash for new equipment and financed an additional $22 in plant asset acquisitions by borrowing the full amount. That means their total capital expenditures are $127. Now the note here is not on an exam, but the note here is for us just to discuss that 22 of the plant asset acquisition is a non-cash event and is not reported on the statement of cash flows. So again, thinking about our investing activities, we have a plant acquisition, we have 105 in cash, and we have 22 that's financed. Now again, I think you should, write this down as you go along, but that's just my style. You don't have to do it that way. And now the company borrowed $100,000 by issuing long-term debt, So up here, borrowed 100. And plant assets were sold and that's in cash for 165. So we're starting to get information now about acquisitions and disposals. We're starting to get information about financing. Of course, dividends are also part of financing. Now, how much debt did you incur this year? $100,000 in cash, but what else do I know? I also borrowed $22 on the asset acquisition. So I know this is a cash acquisition. 22 is to finance plant assets. Okay. So I must have borrowed 122 in total. I have 127 in total assets acquired, and I've got 165 in assets disposed. Now, the fact that you sold the assets at book value means what? There's no gain or loss, and that's consistent with what we see on the income statement. All right, so there's no gain or loss here. It's consistent with what I found on the income statement, correct? If I sell something at its book value, there's no gain or loss. Okay. All right. Any questions on the information? So that's a standard package of data that you would get if you were given a problem like this. Any questions on the information? Okay. All right, now, the way I would solve this problem, and the way I would recommend that you solve the problem, is whether it's direct or indirect, the first step is isolate the changes and then classify them. So that before you even start making up T accounts or playing around with worksheets, why don't you find out what the changes are and then decide whether they're operating or financing. It's kind of easy to do it that way. So if you go to the next page, I take the changes and then I'm going to classify them. So I look at cash and cash equivalents, and again, that's coming off the balance sheet. I mean, the balance sheet's here. I know it's hard to see, but that's the way the balance sheet would appear. So you had 60 to end the year, 85 to begin the year in cash, and you have a decline in cash of 25, and that's your answer. Now, the nice thing about the cash flow statement is you know the answer. The bad thing is you know the answer. What I mean by that is you know the answer, and then you start spinning your wheels trying to force the cash flow statement to get to that number. That's the worst thing you can do. Just do the problem. If it doesn't come out to the number, you're better off because you probably have everything in there that makes sense. You might have a number that you entered twice, or you may have put the wrong number down. You're better off leaving it. If you start spinning numbers until they work, because don't forget, it's got to work. As I proved to you last class, it's an equation. So if you juggle the equation around somehow with some mechanism that you use, you might get it to come to minus 25, but that's not the answer. Accounts receivable goes up by 25, that's an operating cash flow. Inventory goes up by 180, that's also operating. Prepaid expenses go up by 50, that's also operating. Now, what you need to remember is that all operating cash flows, you just leave them alone. You don't have to worry about those changes. We work on a net cash flow basis. You don't even have to look at those numbers. You use them as is. You just take those numbers. The problem here is that when you look at investing activities, and incidentally depreciation, I have a footnote, because depreciation coming out of accumulated is an add back in the operating activity section of the indirect cash flow approach. And also, you have to worry about the amount of accumulated depreciation you removed on a sale of the plant assets. So, again, it's kind of a hybrid. But when you look at investing activities, you have to do an account analysis. You have to use a T account. Why? Well, right now, I don't see how this is $61. Notice it says it went down by 61. I bought 127 and I sold 165, but that's book value. So again, I've got a problem here because I've got to reconcile that. So I'm going to need to use T accounts for plant assets and investing activities. So once again, these items, the investing activities, are going to result in more analysis. These are gross change accounts. You just can't accept the net change. So what I've seen people do is take that change and say, okay, plant assets went down by 61. So in investing activities, I'm going to put down that I got $61 in cash from selling that asset, which is absolutely wrong. So you have to break that up. You got to find out what's going on. In fact, you know what's going on in here, right? I mean, you can actually see it, that I've got different changes that are going through. Sure. It's on the income statement. So if you go back to the income statement, it tells us that right here on the income statement, that's page, first page. Right. And that's 12. Okay, no problem. Any other questions? All right, now the other changes, accounts payable goes up by 3, tax payable goes up by 20, those are operating. Long-term debt, cap stock, and retained earnings, well, I've got to obviously do more here because these are gross change accounts. Investing and financing are gross change accounts, so I'm going to have to make sure I reconcile those changes. I need more work to be done here, but not necessarily too much work because I know that I've got nothing happening in cap stock, so I can just ignore that for this problem, but in other problems you'd have to work with that. Long-term debt, I'm actually pretty good, right, because I have the number already. So if you do the upfront work, and I'll go through more than I have to for this, but you've got that figured out. And then retained earnings will also go through an analysis because you have to make sure you reconcile net income and the dividends. But of course, in our case, it's actually very simple. I already gave you the answer. Because if you go back up to the income statement, you could see what happened, how the account changed. Retained earnings started at 37, and then that's the net income, and you paid dividends of 12, and then of course the ending balance is going to be, open up at 40 rather, net income of 37, dividends of 12, and the ending balance is 65. But I'll go through the T account again anyway, but those are the accounts you'd have to work with. So basically what I'm saying to you is if you want to, you can make T accounts for all of these, but you don't need to. You only need to analyze the gross change accounts, and those would be, in fact, the investing and financing cash flows. All right, so that's the first step, whether you're solving direct or indirect. And I'll get back to those items shaded in green in just a moment. The first thing I want to do is start to solve the problem, and let's do the direct method first. So let's go through each line item. If you go to the income statement, you'll find out that sales are 500. Accounts receivable increased. So, we have this sheet now. And if you're doing this on an exam, or if you're trying the self-assessment problem, what you should do is not make up a table like the one you see on the monitor. What you should do is simply make a column on the right side of the balance sheet. Right? You get a balance sheet, just make the column, make the changes, and classify it. So increase in receivable is 25. Cash collected from customers is 475. Cash paid to suppliers. We did this on Tuesday. You've got to go through a two-step approach. You first have to come up with accrual basis purchases and then determine whether you paid for them. So first of all, you've got cash paid to suppliers. If you go to the income statement, the cost of goods sold is minus or negative 380. On the balance sheet, inventory went up by 180. That means that not only did you have to cover the units you sold, you had to cover increases in the warehouse. So you had to buy $560 worth of inventory. Let me make that clear again. You had to cover your sales, so you had to come up with inventory worth 380. Then you also had to cover an increase in the warehouse of 180. So 560 is your purchases. Now, whether you paid for that or not depends on what? Accounts payable. If accounts payable goes up by 3, that means you only paid 557. So the increase in accounts payable is going to obviously reduce the cash flow needed to pay for inventory. So far you got cash collected from customers, 475. You've got 557 as amount paid to suppliers. But again, the two-step approach, you first get purchases and then you get cash paid. Questions on that one? Because that one seems to be always a little bit of a problem. And again, these are all on page 3. All right, go to the next one. Now we've got cash paid to operating expenses. On the income statement, you'll find general expenses of 30, but your prepaid expenses went up. If prepaid expenses go up, it increases the cash outflow because remember, you debit prepaid expense, you credit cash. That's an asset on the balance sheet, but for cash flow purposes, it's what? An expenditure. Yeah, if you look at the increase in prepaids, how do you record prepaid expenses? When you pay insurance in advance, what's the journal entry? Yeah, you debit the asset prepaid, and you credit the asset cash, exactly. So the cash goes out, but it's not an operating expense. But since we're doing cash accounting now, we have to show that as an expense. All right. So you paid 80 for operating expenses. Incidentally, you notice that depreciation is not even considered. You don't even have to worry about it. It's just not going to show up here. Cash paid for taxes. If you go back to the income statement, you're going to find that your taxes were 21, but on the balance sheet, when you look at the changes for tax payable, so if you go again here, your tax payable is going to be going up by 20. If they go up by 20, that means that those are taxes you didn't pay, and you only paid 1 for tax. And then finally on interest, it's negative 10 on the income statement, but there's no payable. So just like the dividends, if you don't see interest payable, it means that all the interest had to be paid. So your interest paid is going to be 10. Now, the important point here is that whether or not you're asked for an indirect cash flow or direct cash flow. So what if you really are comfortable with indirect? You don't like the direct method, so, oh, great, I'm getting an indirect. You still have a disclosure to worry about. On the indirect method, you have to disclose, and I'll explain why in a minute. You have to disclose cash paid for tax, cash paid for interest. You have to disclose that. So whether or not you like direct cash flow, whether or not it ever becomes part of GAAP as the only way to handle cash flows, you still need to know how to get taxes paid and interest paid on a direct basis, on a direct cash flow basis. Now, before we put together the statement of cash flows on a direct basis, we can't just stop with the operating cash flows. We need to work with the investing and financing cash flows. Any questions on operating? You sure? No, this is good. Yeah, you got to ask questions. Yep. It's a disclosure. Yeah, it's a disclosure for the indirect cash flow method. Yeah, but you'd find tax expense on the income statement, right? So the point I'm making is that the disclosures for the indirect cash flow require that you calculate tax paid and interest paid. Yep. Yeah. So I might give you an indirect cash flow, and you still have to calculate cash paid for tax, cash paid for interest on a direct cash flow basis. Okay. All right. So now let's look at the investing and financing cash flows, and these again are accounts that require an analysis of what I would say gross changes. Now, these are the 4 accounts that I've picked for this purpose. I got to make a correction here. If you look at the beginning retained earnings, is that right? No, that's correct. Hold on a second. Correct. I just did the wrong one. That's correct. This is fine. It's the beginning retained earnings should have been 40. So just correct the beginning retained earnings here at 40. Okay. So the first thing I want to do is I want to make sure I've explained all of the changes in the accounts that are involved in the investing and financing area. So if you look at plant assets, if you go back to the balance sheet, you can see it up on the screen, or at least if you go back to that page, I know that plant assets began the year with 255. They ended the year with 194. Now, if I look at my acquisitions, I know that from the data that was given, I acquired 127 in new plant. I don't know the cost of the assets sold. I've got what? The book value. Now, what's the book value? What's the book value of a plant asset? Right, it's the cost minus the accumulated. So I need to know both the cost and the accumulated on that. So if you look at the entry, and I don't advocate plugging entries, but that's all you can do unless you're auditing this company. So in this case, you know that if you added 127 here, it's certainly not going to be the 194. So to get the asset account to balance, you have to assume that you sold 188 in plant and equipment. Now, in order to prove that, if you go to the depreciation account, you look at the beginning balance, it's 100. The ending balance is 99. That means that it would appear you have negative depreciation. Something's happening. I mean, obviously, you got depreciation of 22. So the ending balance would have been 122 here. But what happened? You sold an asset. You must have removed 23 on the sale. So to prove that out, of course, you get the net book value this way, in the sense that you know that you removed 188 and on the cost, and you also eliminated 23 on the depreciation. So now I have the numbers I need to go forward. Now, could you get away with the problem without doing this? Yeah, I mean, in this case, it's a simple problem. It'll work. I mean, all you need to know in this problem is that you paid 105 in cash and you got 165 in cash on the investing. But I just want you to be clear that in a lot of problems, you're going to need to scrub those accounts to make sure you know the numbers that are in there, because sometimes you got to find out the cash flow this way. So in this case, you wouldn't need it. In fact, in the retained earnings, you don't need to do anything. You have these numbers already, so that you know that the beginning was 40 and net income is 37, and it would have been 77, but the ending balance is 65, and that's because you had dividends declared, but also dividends were paid, because there were no dividends payable on the balance sheet. And then finally, long-term debt, we know started with 100, ended at 222. Just to be sure, I can verify that they borrowed 100 on a note for cash, and they also financed the plan asset for 22, so we know it's 122. So we know they borrowed another 122. So there's an equipment note of 22, and the additional borrowing is 100, so we know that already, and we've reconciled these. So in this case, it should be relatively simple. But in other cases, make sure that you go through the analysis of the investing and financing accounts. And unlike most textbooks, I would say that, yeah, you've got to go through every T account, build worksheets, Excel worksheets to build a cash flow statement. If you're at a client, if you're at a client with hundreds and thousands of different transactions and accounts. But for a textbook, you're wasting tons of time. I mean, if you sat there and did a T account for receivables, a T account for inventory, I mean, you could probably try to do that, but it doesn't make any sense. It doesn't get you anywhere for this problem, because the inventory, the prepaids, all of the operating working capital accounts, we work on a net cash flow basis. So just remember that. That'll save you a lot of time. All right, now, for the solution, and here's the cash flow statement on the direct basis. On a direct cash flow basis, you have these minimum line items, and you have to come up with, as you can see, cash from customers, 475, then the outflows, cash paid to suppliers, 557, cash paid for other operating expenses, 80, and then interest paid, and then taxes paid. We'll talk about capitalized interest later on in this semester, and cash used from operations is 173. Cash flow from investing, as I said, you didn't have to go through all that analysis, but I just want to be sure you know the technique. In this case, they sold the equipment for 165, and that is already established by the data. Capital expenditures. Notice you purchased, and I want you to be very clear, you purchased 127 worth of assets, but only 105 goes on the statement of cash flows. Why? Because 22 is a non-cash financing and investing activities. That's got to be disclosed. That's not going to go on the statement. Now, you put it on the statement, you're going to get the right answer, or at least you'll get the 25 decline in cash, but you're wrong. So this cannot go on the cash flow statement. Yeah, you spent 127 in total asset acquisitions, but the problem is only 105 of that's in cash. If it's a non-cash financing and investing activity, it does not go on the statement of cash flows. It's got to be disclosed separately. And this is where we move a little bit from intro. I mean, you don't worry about disclosures on intro. Yeah. Well, the problem would have to be clear and said that they signed a note at an equipment dealer. If you signed the note at the dealer, I mean, this is kind of odd, and I don't know if, I think I mentioned this before, I find it kind of strange that if you, let's say go to the car dealer and you say, okay, I want to buy this car, and for some odd reason you're able to get a loan instantly, and you just go to the bank, get a check, and walk back to the dealer, that would go on the cash flow statement. But the fact that you really didn't receive any cash and you just signed the note, if you go to the dealer, sign the note, walk out with the car, there's no cash flow. Yeah. Well, I gave you in the additional information. Where's that, please? Here it is. Right here, I said that they borrowed the full amount, and I made the note there, but I would obviously change the wording. So if you go to the additional information, that tells you that the planned asset acquisition, I'm just telling you it's not cash flow, but here I would just say they financed it at the equipment dealer. So they signed the note at the dealer. I'd make it clear that they didn't borrow the money first. Okay. Yeah, it would be in a footnote to the financials. We'll show you that in a moment. All right, so any other questions about the non-cash event that does not go on the cash flow statement? And then, of course, for financing cash flows, once again, same story up here. Let's just make sure they borrowed 122, but 22 million of that is not borrowed in cash. It's a note you signed at the dealer. It's a non-cash event. So only 100 goes on the statement of cash flows, and dividends paid are 12. Cash provided by financing is 88. The change in cash, negative 25. And of course, you reconcile back to the ending cash flow. You have to have that reconciliation. The ending cash balance, rather, is 60. So that reconciliation is part of the cash flow statement. So negative 173 in operating cash flows, 60 provided by investing, and 88 provided by financing. Change in cash, 25. Opening balance of cash is 65. And then, of course, it ties back to the balance sheet. Now, that is the statement of cash flows on a direct basis. Now, we'll talk about more disclosures, getting back to Melanie, if you had a question about that, I'll do that in a second. Any questions on a direct cash flow statement? Okay, make sure you try that, the self-assessment. I give you the solution. I will, post that, but work through it. Make sure you know how to get to each one of these line items. Now, as I said, what we do in intermediate, which is a little bit different than in intro, is we spend more time on disclosures. And these are, if we look at the disclosures, for the direct method. All right, there are three. The first one is the reconciliation. And this is where a lot of people who advocate the direct cash flow say that, well, it's kind of nonsense to argue that you can't follow this, because in the footnote, we have to give you exactly the same numbers you see on the indirect basis. So we basically take exactly the same numbers that you're going to use for the indirect method. We start with net income of 37. And where does that come from? Of course, that comes from the income statement. And then we take the changes, which you developed here on page 3. So we know that depreciation, of course, is a non-cash expense. We add that back. Increase in accounts receivable, 25. Receivables that go up means that sales were not collected. Prepaid expenses of 50, meaning again that you debited a prepaid expense, you credit cash. That cash outflow was an asset on the balance sheet, but it uses cash for operating activities, so it's deducted. Then you've got inventory going up by 180, that gets subtracted. Increase in tax payable, taxes you didn't pay, it's an add back. Increase in accounts payable of 3, inventory you didn't pay, and that's an add back. Now, what you don't see here, and this is a great way for you to compare direct and indirect, what you really don't see here is the fact that the inventory and the accounts payable adjustment are really adjusting what number? Cost of goods sold, up in the income statement. The depreciation number, of course, is adjusting your depreciation down to zero. The prepaids are adjusting the operating expenses. So this is the problem with the indirect method. It does obscure a lot of information. But nonetheless, that's your first disclosure, and that is the indirect approach. Now, that's going to save us tons of time because we're not going to need to worry about the actual creation in a minute. We'll show you, but when you do the indirect method, you've already got it. Questions on this? Any questions on the indirect or this reconciliation that's required? Okay, second type of disclosure. You have significant non-cash investing. And financing activities. So the second disclosure would tell you that the company acquired equipment of $22 million that was purchased with long-term notes. So that's the way you would see it. Melanie, that's the way you would see that in the financials. The problem, by the way, is I don't know where I'm going to find that. I may find it in management's discussion and analysis. I may find it in a separate footnote in the long-term debt section. I may find it in a plant asset footnote. I may find it on the cash flow statement on the bottom as a supplement. So where it's actually disclosed is up to the company, but it has to be there. And the third is the definition of cash equivalents. Definition of cash equivalents. And it tells you that for purposes of the statement of cash flows, company considers all highly liquid investments purchased with maturities of 3 months or less to be cash equivalents. So those are the required disclosures that must be presented on the direct method cash flow statement. All right, so any questions on developing the statement, getting the numbers? I mean, hopefully you sort of observed technique. You don't have to follow it, but I just find getting your information organized. The toughest thing with a cash flow statement is when you're trying to put it together and you're looking for information, flipping back and forth to a balance sheet, this way you have everything right up front. You have all the information that you need. Now, once you do the direct method, the indirect method's easy because operating activities we already did them. So if this was the indirect method, we've got the reconciliation, which we've already seen in the footnote for the direct approach. So the indirect method is pretty simple. We've already done the operating activity section. And the investing and financing, as we said, on a direct cash flow basis, in a sense, are the same. Now, again, what I meant about gross changes, let me just make sure you understand the concept. On the operating activity section, you do not need to break out all of the changes in inventory. So I don't need to know how much inventory was purchased and how much inventory was sold. I don't need to know that. I just need the net change. That's it. But when I go to something like an investing activity, I need the gross changes. I need to know how much did you buy in cash and how much cash did you get on a sale. I have to show the gross changes. I can't net these out. I'm not permitted to net those out. And that's what requires the additional analysis. The same thing's true down here. I borrowed money, but you know what? I might have paid some back. I've got to show them separately. I have to show all purchases and all sales of, all issuances and all payments of long-term debt. Same thing with issuing stock and buying treasury stock. I have to show that separately. So just remember that operating cash flows, we use net changes. Investing and financing, we use gross changes. Now, we've already done the operating activity section. Remember, the way I like to look at this is you got two groups of adjustments. You got the non-cash adjustments, and then you got the changes in operating working capital. This is the investment in operating working capital, and some companies like Coca-Cola like to take this and put it in a footnote and just show you one line. This is going to get a lot more complicated when we bring in deferred taxes and pensions next semester. Also, it gets even more complex when you get into the summer with mergers and acquisitions. The strangest thing in the world, mergers and acquisitions will always distort the cash flow statement. I'm going to tell you that for 99% of the Fortune 500 companies, if you look at their cash flow statements, you're going to say, this is great, just cover this in class, you know, and you're doing your project, let's say, in the summer. You go to the balance sheet, you get the change in inventory. Then you go to the cash flow statement, it's not going to be the same because it's adjusted for mergers and acquisitions and it's adjusted for changes in your foreign currency translation. It just gets a little bit messy. So it's not as clean as we would think. And it also sort of shoots down the argument that these numbers are easier to follow. And you'll see that in the summer. If you want to, in your spare time, after I guess you have an exam today, but after, you know, the smoke clears a little bit, go to the Coca-Cola statements, or go to any statement. Get a balance sheet change, and then try to find that number on the statement of cash flow. So take the change in inventory, and sometimes they're so bizarre that inventory goes up on the balance sheet, but then when you get to the cash flow statement, it's viewed as a decline in inventory. It's just, and you'll see that during the advanced accounting in the summer. All right, so does anyone have any questions now regarding the nature of the cash flow statement on an indirect basis? Now, here's the issue that I think I know you don't see it in the intro, so let's do indirect method. And these are your disclosures. So the first thing you have to disclose is going to be cash paid for interest and taxes. Now, this has already been done. And if you remember, I said that, well, you may not like the direct method, but if you're doing an indirect cash flow, you still have to come up with those numbers. And we already calculated them on the direct cash flow basis, right? So you already have these numbers. Now, why do I need those disclosures? The most important thing that I try to emphasize is I know it's rough. You're going through a lot of stuff, and you're just hopefully hanging on to know how to do something or if something's required. Why do you need these numbers? What the FASB is trying to do is to kind of correct the poor definition we have of operations. Remember I said that I've been always criticizing the FASB's definition of operations because it doesn't make sense. It includes interest and taxes. So what this disclosure allows you to do is to actually create a cash measure. So what you could do, and this is called earnings before interest and taxes, depreciation and amortization, because you already have depreciation and amortization out of here. What you can do is clean up the notion of operations. Don't forget, the accounting definition of operations is not a clean measure. It includes taxes, it includes interest and the like, interest paid and interest expense. Now, most of the time we net these out. So we could have net interest paid, it's net of interest received. But we don't have any interest received here. So notice what happens. If you take operating cash flows minus 173, add back the cash paid for interest, add back the cash paid for taxes, you get a clean measure of earnings before interest and taxes and depreciation and amortization on a cash basis. So this is basically the cash that you used up in operations in the true sense of the word, EBIT or EBITDA as we call it. So the disclosure is there to enable a user to correct the accounting definition of operations. So when we say operating activities, we're wrong because we have obviously taxes and interest in there as well. All right, so that's the purpose of that disclosure. Yes, Sal? Depreciation is already added back up here. So I've already added back the depreciation. I've already excluded the depreciation effect. So when you look at operating cash flow up here, you've already 173 already takes out the depreciation, so it's already after depreciation. So it's earnings. This is operating cash flow, but it's already after the non-cash expenses have been excluded. Anyone else with a question on that first disclosure? Okay. Second disclosure is the same. And that is the disclosure of significant non-cash investing and financing activities. And the third disclosure is also the same, which is the accounting policy on the definition of cash equivalents. That's the same as the direct method. All right, so any further questions? Now, again, I would highly recommend that you play around with the self-assessment exercise. I'll post that if you're uncomfortable with cash flow. If it's easy, then don't worry about it. It's not a requirement, but it's there for you to work with. Now, with the time remaining, we should be able to at least talk a little bit about IFRS. And as I said, what I will try to do throughout the next couple of semesters is only cover IFRS where it is significantly different than US GAAP and where I think it's still going to play a big role on the CPA exam. As I said, convergence will happen, but it's going to be less likely in the near future. It's probably going to be pushed back quite a few years, maybe 2016, until we actually see more convergence. But here's what happens with IFRS. IFRS is a much cleaner, takes a much cleaner view of operating cash flows and gives companies options in reporting. So let's take the first line item. The interest and dividend income, they could go into operating activities or in investing activities. They give you the choice. So I think it makes more sense that dividends received and interest received go into your investing activities. You have a choice. Interest expense that's paid could go into operating or it could go into financing. Now, theoretically, financing makes more sense, but from what I'm reading from IFRS statements and literature, a lot of people believe that it really belongs in operations, especially if the interest is what? Used to finance acquisitions of inventory. So there's a very strong view that interest paid should be part of operations because it is in fact needed for the company's day-to-day activities. Dividends paid, well, it's rare, but they do give you the option to put this into operations. Same argument. If you're financing through equity, the cost of equity financing should be considered part of operations. And taxes. operating. I mean, basically, it's agreed almost universally that you should have taxes in operating activities. But IFRS allows you the option to allocate taxes to the sources of the tax. So any tax paid on operations, on income, goes into operating activities. Any taxes paid because you retired debt early at a gain goes into financing. Any debt or any taxes paid on a gain on a sale of a plant asset goes into investing. So that's another option. So you have to understand that these are relatively flexible in the IFRS standards. Now, let me show you one illustration of this. And first, let's go to page 9. Now, this is the cash flow statement. This is an IFRS cash flow statement, the way it would look. And by the way, you'll note that the IFRS style or European style of reporting always has a footnote in a column, so you could always go back and find it. So we're going to go back to the footnote in a moment. But if you look at the first line of the cash flow statement, it says cash generated from operations. That is on footnote 34. That is a absolute clean number of operating cash flow. That is cash before interest, dividends, taxes, and everything. It's an absolutely perfect definition. And then, as I said, this, and I'll get back to this, as I said, most advocates in the IFRS standard setting believe that, yeah, although we give you the option to have interest paid in financing and income tax paid in different activities, it makes sense that interest is an integral part of your operations and taxes are definitely part of operations. So their net cash is more of a hybrid of what we do under U.S. GAAP. And then, of course, and I'll get back to that footnote in a second, and then, of course, this particular company decided in its investing activities to put interest received and dividends received here rather than operations. Don't forget, in U.S. GAAP, these go in operating cash flow. So it makes much more sense for us to see this as part of their investing activities. Now, the only thing here is that, dividends paid, they're keeping those in financing. There is an option to put those in operations, but it makes more sense to keep them there. So again, on the IFRS approach, you do get this very clean, or this I guess, correct measure of cash flow from operations, and then it's adjusted because of the belief that interest and taxes really belong in operations. Now, let's go back to footnote 34, and that's on page 8. And this is a separate footnote, very much like you would see in, Coca-Cola, for example. But this includes the investing, this includes the operating activities. Notice the first thing. The very first line, right here, if I can get it, there it is. That very first line is profit before tax. That's a pre-tax number. So they've already taken tax out of there, so you don't have to worry about any adjustments. And then, of course, they add back depreciation, depletion, amortization. And then notice what they're doing. Interest and dividend income, which is included in profit. Interest and dividend income, which is included in profit, is subtracted because we're trying to get a clean measure of operations. We're trying to remove out of operations income that is non-operating, technically. Then your dividend income also is non-operating income, so we subtract that. And then interest, your finance costs, are added back because, again, we're trying to get a clean measure of operating income. So what you have here is exactly what I mentioned before. When you do your changes, in your operating working capital accounts, you get cash generated from operations. That's the measure we start the cash flow statement with, and that is in fact a very clear and clean definition of cash basis earnings before interest, taxes, depreciation, and amortization. That is an absolutely clean measure of that. So under IFRS, you've got all of these options. What you're seeing here is probably the most likely scenario where you have, when you get back to the actual statement, this is the pure measure of cash generated before interest, taxes, depreciation, amortization. You probably, most likely, will see interest and taxes paid in the operating activity section, and you'd probably see the interest and dividends received in the investing section. Okay, so that is a cash flow statement under IFRS. And I would say that, again, when you look at CPA exam questions, and again, don't forget, not only CPA exam, but as I mentioned, if you work in any company, any CPA firm that has clients with international operations, you will see IFRS-based statements. And you'll also see it if you're in a corporate setting. So, again, you have to think about, I mean, some companies, I should mention this, some companies already have, adopted, U.S. companies have adopted IFRS on a full-blown basis. I think Ford actually dedicated an entire, floor of a building to convert all of their accounting systems to IFRS, so they have it, it's ready, and they could always produce IFRS-based statements. So just be familiar with some of these, I guess, nuances, and realize and be able to compare them to U.S. GAAP. All right, any other questions or any questions on IFRS? So it's something I guess you have to make sure you're clear about, make sure you compare it to U.S. GAAP. All right, now the last thing in this chapter is a project that keeps going backwards, but it's still on the table. The FASB and the IASB are working on a new way to present financial statements, and it is radically different than what you've seen so far. So if you take a look at this diagram, what we're trying to do, and I'll update you on this as we go along if there are any changes, but what companies are trying to do, or I'm sorry, what the standard setters are trying to do is get the financial statements of the balance sheet and the statement of comprehensive income, which is net income plus other comprehensive income, to line up with the cash flow statement so that you've got operating assets, you can compare them to operating income, and you can compare that to operating cash flow. So you notice they have different sections, different categories. They now have, a business section, a financing section. They're going to change the cash flow statement a little bit, and the income tax section, the discontinued operations section, then a section on comprehensive income. So I just thought I'd show you this, which I found, this is something I picked up from PwC. I don't even want to start talking too much about this. I couldn't figure this thing out. I mean, if you look at this, just look at the assets. So they're saying that they got business assets, and some of these business assets are operating. So, all right, this makes sense. You got cash, receivables, inventory. Then you've got long-term operating assets. So then you've got your plan assets. And then you've got liabilities that they consider business operating liabilities on a long-term basis. And then you got them on a long-term basis. And then you go to something called financing or operating financing. So, and then you go down to this pension liability. And then you have net operating assets. So they're netting the assets against the liabilities. Then they have investing, and they have net business assets. Then on the next page, they have financing, debt. Then they go into the equity. And then I'm trying to figure out how the balance sheet balances. And it's pretty bizarre because the balance sheet, it's kind of hard to balance the balance sheet. But it looks like, if we look right here, total equity is 2,685,679. The only way it balances is if you add it to total assets and total liabilities, but these numbers are coming from all different places. So it's extremely confusing, and I hope they don't go to it, but if they do, this is what it would look like. So, and hopefully you take the CPA exam before this ever happens. So again, there is a movement to do this, which I think would probably happen later than sooner because of, I mean, I think it makes a lot of sense to me to have everything line up so you could track assets against the income that's generated from those assets and then the cash flow that's generated from that income. I mean, I don't know if you get what they're trying to say, but again, let me repeat what the intent is. The intent is, well, look, here's what we want. We want you to understand the assets that you have that are available to generate a certain type of income, and then you want to see the cash that's generated from that category of income, which makes sense. It's logical, but the actual way they put that together could be a little bit difficult. Okay. All right, and finally, in this chapter, what I'd like you to do is take a look at the self-assessment exercise. It's very similar. There are some differences to the question that we had. It asks you for and these are pro forma means projected, but that doesn't matter. It'll be the same thing. I want you to use the indirect method, but I also want you to be able to come up with the line items that you see here. I give you the direct method. So again, it's entirely up to you. It's your call whether or not you want to do this problem. But again, it is a good way to review the statement of cash flows, okay, aside from like regular homework problems and things like that.